It's me, Stephen Thomas, with Reports on Housing. And I'm coming to you on this Friday before Thanksgiving, November 21st. And we've got another housing debrief. And I wanted to get right into this week's housing debrief. And this week we're focusing on housing's holiday surprise. And it's kind of like it sneaks up on everybody. And I've been talking about this in all my presentations, that there's something that we're seeing in the data and the numbers that shows that we're going to have something else that sneaks up on us, and it's going to start like right now. And this also snuck up on us, and that is the amount of homes that are currently on the market. And you hear about this from everybody, that the number of homes in the market has definitely increased. I'm showing you 2023, 2024, and 2025, a lot more homes have come on the market. And when it's taken out of context like this, and that's the whole thing, it's all about context, because so many people do that. They say, look at how much more homes that are on the market. It's just there are way too many homes on the market, but you really got to look at it in context. That little white arrow that I had on the other slide is this particular arrow. This is what we're talking about. So yes, we've had inventory that has been rising, but it still hasn't even got to where we were prior to the pandemic, 2019. And it's still an inventory crisis. It's just being matched up against very, very little demand. So that's the supply and demand equation that we're dealing with, where there's still very, very little supply, but there's more supply, but it's being matched up against very little demand because of where interest rates are at. But the reason we don't have plunging prices, this shows it, that we don't have enough inventory. We have to have a gargantuan amount of more inventory than we have right now for prices to come down. And you have to have a lot of foreclosures and short sales and a lot of must sells in the marketplace. And we're just absent that. Instead, there is a lot of equity. I'm not even going to get into all the nuances of that, but we're focusing on things that are sneaking up on us. This actually snuck up on everybody. Didn't really sneak up on us because we were tracking it. And really what's been going on is on the supply and demand side of the equation, like I've said, is in 2023 and in 2024, there was more demand than there was supply. Supply was so low. People thought with these extra high interest rates that we should have prices come down a lot faster. But what happened was there still was very limited supply in the marketplace. And as a result, this whole demand and supply thing, where there was just a little bit more demand than there was supply, and as a result, we had prices going up. But what happened over like the last couple of years is in 2023, nobody came on the market. Very few homes came on the market because of how low rates were, and then they had gone up to a point where they went from 3s to all the way up into the 7s, and everybody was kind of like, I had this real low rate. I don't want to move in 2023. I heard that rates are going to come down soon. That's what everybody said in 2023. We're going to have rates down in the 5s. And that just never materialized. But everybody is all, I'm not placing my home on the market right now. I just bought one, or I just refinanced. I got this low rate. Now look at where rates are at today. And as a result, very few homes came on the market in 2023. And we just had very limited supply against very little demand. Then in 2024, there were more homes that came on the market. In 2025, even more homes that came on the market. And as a result, over like the last couple of years, it was matched up against demand that really wasn't changing. But on the supply side, we were getting more and more inventory. So that's how the inventory game snuck up on us, that all of a sudden there's a lot more homes in the marketplace. But we were tracking that. We actually could see it. You could see what the trends were. But this is the overall arching theme, is a lot of people weren't paying attention to the market was slowly but surely changing. And it changes at a snail's pace. So 2023 is hot. 2024, we're seeing more homes on the market. More people are coming on the market in 2025. Even more homes coming on the market. Demand's not changing. And you could see this evolution of these extra homes that were coming on the market. And what they were doing is they were accumulating, building this inventory over time, slowly but surely. And you could see it actually in pricing, that there was enough juice. And if you see this on the right-hand side, there was enough. This is Zillow's house price index on a month-to-month basis. And you could see where prices came down in 2025 across the United States, but now they're going positive. And there's a reason they're going positive right now. And we'll get into that because there's something else that is sneaking up on us right now. And a lot of people aren't paying attention to it. And but first, I'd like to bring in our sponsor, and our sponsor is Ashley Griffin from JMJ Financial, and she could be reached at 805-402-8125. That's Ashley Griffin with JMJ Financial, the Thibodeau Morel Group, and she has this great product, a guaranteed backup contract. And really what that is, it's bridged the gap between selling and buying without the stress. So you can have a bona fide purchase contract on the departing residence. So you're actually going to get a contract on your departing residence. And this contract allows JMJ to exclude debt on a borrower's departing residence while allowing the borrowers to retain all the freedom and flexibility to maximize their sales price up to 6 months after their purchase closes. So what this is JMJ provides a non-contingent offer for the borrower's departing residence at 80% of the fair market value. And the borrower is able to sell their departing residence with their own realtor for up to 6 months. And after 6 months, an extension request can be granted. It may be. And if you're unable to sell the property within 6 months time frame and do not wish to file for an extension, they can facilitate the sale and you'll receive 100% of the proceeds. So contact Ashley Griffin at JMJ Financial, the Thibodeau Morel Group, at 805-402-8125. That's 805-402-8125. And now back to the program. And something else is sneaking up on us. We had an inventory sneak up on everybody. We could see it in the data, but this is what it feels like when you're in the trenches working on a daily basis. You go, how in the world did we get all these homes? There's a reason behind why we got all these homes. And that's the next thing that's sneaking up on us is mortgage rates. And you could see what's going on now over time. And you could see that rates they were stuck in between what we called mortgage rate purgatory. And that was from 6.5% to 7.5% for close to 3 years. And there's very few exceptions. And you can actually see this. This is from Optimal Blue. The green line is this year's mortgage rates, and the blue line is last year's mortgage rates. And you could see where it dipped down below 6.5% last year, but then it came down and then went up. The difference between last year and this year is that was this sudden drop, and then it felt like it was too low. And as a matter of fact, it really went up quickly, that it was going down for all the wrong reasons. And even though the Fed was reducing the federal funds short-term rate, it still felt like the mortgage rates had come down too fast, and as they did bounce off that bottom and went right back up. So you can see the blue line kind of like a toilet bowl, comes down, goes right back up. Now the green line is this year, and it was this material change from about the end of May on, this slow regression in interest rates. It was slowly going down until we've been battling right now right around between 6.1 and 6.3%. So those are really good rates. You could see it's been stagnating there. It probably would have gone down even lower towards 6% had we had more labor reports that were able to come out. The initial initial claims comes out every Thursday. That has been gone because of the government shutdown. And then the jobs report, we just got September's jobs report, and it was a big beat. Probably will get revised later. It just has to do with the number of they had data, and it was data that was recent and at the beginning of October for the month of September, and they haven't been able to do their due diligence to fix it or anything at this point. This is most likely going to be revised down, but October, with all the private reports that are out there, it is showing it's most likely going to be negative, but we will not even get the October report. We're getting the next report will come after the Fed meets, and that will be for the month of November, and that's not until middle of December. All of these reports are late. A big hole for October. We'll get that data later. So what it's been doing is it's been going sideways. We thought it would go down towards 6% or right around there. We could get there next year. It would probably take about the second week of January for it to really start coming down towards 6%. So, but nonetheless, it's below 6.5%, and it's been below 6.5% as I'm doing this right now. It's like it's close. It's getting over the weekend. It'll be over 80 days. Last year we were there for 45 days. That blue line where it dipped below 6.5 and came back up. This year it's below 6.5, and you can see how it is staying there, and it's been this real methodical. It is a right place for mortgage rates to be. It felt too low last year at this time. This year it feels right, and it's that way because the labor market has been deteriorating. And if you don't believe me, take a look at unemployment rate for those that are in the younger brackets, 16 to 24. And those are the people that are having the hardest time finding a job. The people who are just out of college and even youngers. And those that don't have college degrees have the highest unemployment rate right now. And it just shows you that there's some weakness that's in the economy, which means that rates will continue to come down. And they've been coming down nicely because the spread has been getting a lot better over time ever since they ratcheted up rates as much as they did back in 2022, and we went from 3.25 to 7.375. I mean, we were at 3.25 all the way up to 7.375. That was a big change from January to October of 2022, and it was such a shock to the system. And that's when they were changing the short-term federal funds rate from 0 up to 5.5 in an extreme short period of time, and then all of a sudden mortgage providers were charging a lot more because they thought that rates would float back down and everybody would be refinancing. So that's something called the spread. The spread got really, really thick, but the spread's been getting better and better, which is why we're enjoying better rates this year than we were last year, way better than 2 years ago when we hit 8% rates, because the spread's been getting better. As a matter of fact, if the spread if we had last year's spread, we would be above 6.5% right now. And if we had the spread of 2 years ago, we'd be above 7%. So the spread's been getting better, and it will continue to get better over time, which means that we can enjoy these 6.5% interest rates for a longer period of time with duration, which is most likely what's going to happen, which is what our base forecast is for next year. And so it will be going sideways, and there is a chance that it'll come down even more with further reports coming out, most likely in the labor arena of the economy. So with that said, you can actually see it would go sideways for now and could even go lower. And this is what happens to rates. You can see it with $3,000 per month with 20% down. You are, if you want that desired monthly payment of 20% down, principal and interest, you're looking at a $500, about $64,000 home when it was at 7% at the end of May. Today, at about 6.25%, you're looking at a $609,000 house. And the only difference is rates are coming down, and it's definitely extremely plausible that we make it down to 6%. Now you're looking at a $625,000 house, and with 20% down, still $3,000 per month because it's at 6%. You can see if the labor market were to crack, we'd get into the fives, and you can imagine, at 5.5, we're looking at a $660,000 house. So that's $100,000 more than it was just last May, and you could see how that would definitely open up affordability, and it's coming right during the holidays. And this is kind of what the holiday surprise really is that we have these low rates. It's better than where we were last year, and it will lead into a start to 2026 that will be better than last year because we were above 7%, and we're going to be close to 6%. There'll be a full percentage point higher interest rates for 2025 versus the start of 2026 will be a lot lower than the start of 2025, full percentage point. So, and we're in the holidays right now, and that's where supply typically plunges, and we see that right now typically right as soon as we're going into Thanksgiving week, which is next week. So we see it in the numbers right now. So supply plunges and demand plunges equally as quick. But what people don't understand, that drop in demand is going to not be as large as the supply plunge from here on for the rest of December. And that is because we have these low rates that are better than they were last year at this time. And that will entice a little bit more demand at the end of the year, it's not like you're going to see this gargantuan amount. But if you're in the arena of buying and you buy now and you look, or you're looking right now and you look a couple weeks later where we're into December, you're going to say, man, it feels a little bit hotter in this marketplace right now. That's weird. It's December. And that is where it's sneaking up on us because of the demand coming down not as fast as supply. So if supply comes down faster than demand, it's just this simple equation. And where we left off is we had a lot more supply, but what's happened is with these rates less than 6.5% is we've been adding to demand. And the longer that they remain below 6.5% and the closer they get towards 6%, that demand is just going to grow. And what happens is that balance scale is you now have more demand than you have supply. And all of a sudden, it is favoring sellers in negotiations. It's not going to be like extreme, but we imagine that this is going to, our base case is it's going to remain this way during our spring market. And if it does remain below 6.5%, this is what we're going to be seeing. And people are going to go, what in the world? How in the world is it a lot busier this year than last year? And it's all because of rates. The market today is very sensitive to rates, and the difference I just showed you in 6% rates versus 7% is huge. And if we get into the fives, it's going to be even busier. And our base forecast is for that not to happen, but it can happen if there is a break in the labor market. If you like this video, please like it and subscribe to our YouTube channel. You can go to reportsonhousing.com for more information. And our most recent report, we have reports that dot all over SoCal, as well as the Bay Area and in Phoenix and Vegas. And the most recent report that came out is called This Season's Silent Nights. And we'll be writing a new one come this Monday. But this is the most recent one. It talks about the holiday market and what to expect. And if you want a free month, utilize the coupon code GOBBLE. Happy Thanksgiving, everybody. Thank you for continuing to tune in and your patronage. I love it. Thank you for being for being here and watching us. And if you have any questions or would like to see something different, or there's something that's a burning question you have, put it in the comments. And I hope you have a fantastic Thanksgiving, and we will see you on the other side.